Welcome to the Whole Enchilada, a community of high achievers that fight the status quo, rebel against mediocrity, and make life happen. Let's go. Hey, Enchilada Nation, excited to have you back today. And back by popular demand, Branden Ducharme, my good friend and brilliant partner, is on the call with us today. Branden, off of our last conversation, I had so many people reach out to me. In fact, it happened again yesterday. I got a private message in Facebook of somebody reposting the conversation we had, and we're just really grateful for some of the comments you made last time. So excited to have you back on the show today with a new topic of conversation, which again may not be the most exciting thing to be talking about because everybody hates insurance until they need it. But we're going to have a high-level conversation around insurance, both property and casualty insurance and life insurance, of some things to consider right now because there may be gaps. You may think you have everything you need in place, but if you've had those policies in place for a while, there may be some things you need to rethink in regards to those policies. And that's what we're going to chat through today. But Branden, anything you want to add? I know you introduced yourself last time. But anything new going on in your world you want to share with our community before we jump in?
There's a lot of new and exciting things going on in my world. Some of them I can't really share right now. They're to be rolled out maybe by the time we record the next episode.
So you're going to tease us. Big things coming.
Excited to share.
Can't tell you.
But things keep moving along, and teams growing, businesses are growing. Assets are growing. That's what's important. So,
yeah, buddy, I love it. I love to see what that you're not only just growing your base business, but you're building the more businesses around it, more energy. I love the way you think around that because I very much play in that space, as you know. All right, well, let's start our conversation. Let's break down our conversation into three parts, really. What I'd like to do is start our conversation around the mindset around insurance. And then move into property and casualty, and then we'll finish our conversation around some ideas or thoughts around life insurance. But one of the bold laws we teach inside the Keller Williams ecosphere is change the way you look at things, and the things you look at change. And that's true with insurance. I think a lot of times we look at insurance, regardless of what type of insurance, from a home warranty to property and casualty to health insurance. And frankly, in some ways, it feels like a little bit of a pain in the butt because you're paying for something you're probably not going to use and hope you don't need. But man, when you need it and you have the right policy in place, does it become a lifesaver? So it's kind of this double-edged sword. But walk me through mindset. You shared some really interesting thoughts around insurance, mindset around insurance in our pre-call, but lead us through that discussion.
Yeah. So the first thing to understand with insurance is where insurance should play a role in your life is for low probability, high impact events, right? So low probability that you get in a really bad car accident, but it would be really impactful if you did, right? Wrecked car, people injured, all these sorts of things, right? Life insurance, low probability you're going to die, really high impact to your family, right? So what you're doing with life insurance or auto insurance, homeowners, all this stuff, you're essentially just making a deal with an insurance company that says, I could not personally bear the liability on this type of event. It would financially ruin me or completely fundamentally change the way in which I'm living my life or accumulating wealth. And so I would like to pay you a premium, either monthly or annually, however you give it to them, but I'd like to pay you to take that risk. So if this event happens, right, I don't have to deal with it. You have to deal with whatever that is. And on the flip side of that, an insurance company is able to say, well, we know that this event doesn't happen to everyone all the time. And so we can collect a small amount of money from a lot of people. And when that does happen, then we'll have the money to kind of pay out and make that person whole. But we can be profitable, and we can use that cash flow as an insurance company to then invest and make additional money and revenue in different ways that way. So if it's not, if it's not something that's high impact and low probability, it's probably an insurance that you will really hate paying because it'll probably get really expensive.
Yeah. I think it's interesting because obviously I think insurance is a very important part of our world because we work so hard for our money. It would be horrible for one event. And the truth is everybody has to lean on an insurance policy at some point, right? It's like You just don't know when it's coming, what that looks like. If you have multiple kids, that probability increases significantly that you're going to need those insurance policies. But it's just this idea of we trade money for getting time back all the time. So for example, like I trade money to someone to take care of my landscaping so I don't have to deal with it. This is they're similar in nature, but I'm paying some element of money for a chance of having to deal with something that I don't want to deal with, and protecting the assets that I do work so hard to create. Because it would be horrible to have one horrible accident happen that I've got to deal with emotionally anyway, that's a challenge, but also comes in and wipes me out financially. So I think it's important to like have that mindset of like, this is, am I making an investment to protect what I've built and also protect my future? But also, I know there's a lot of upselling that happens in the insurance world. That's where I get frustrated, is when am I being sold what I really need plus some, just because there's an opportunity to upsell me there? Or do I really understand what I'm getting and feel like it's a match to what I have in my world?
Well, you certainly want enough insurance that you can walk around life and not be worried everywhere you go all the time that it would just all be over in an instant, right? You need enough insurance that you can stay in the right mindset, focus on the things that are most important, right? If we had to do our jobs without the possibility of ever having any kind of business general liability insurance or, E&O insurance coverage, right? Every interaction you ever had with the public, you would never be able to conduct business and make revenue because you would be so concerned about getting sued out of business, right? And so if you have the right amount of coverage, you can stay focused on what you're doing in your business, right? And make revenue. So there's a certain element that if you understand that the insurance company is providing you the protection to go out and just live a pretty normal life, all of a sudden it becomes an easier pill to swallow to pay that premium and say, okay, I know I'm taken care of over there. So now I can go focus on what's most important and get back to building wealth, right? So if I protect it the right way, now I can really build it and not have to worry about protecting it personally as I build it and hide it from people or whatever, kind of way you want to think about it, right?
Yep. Yeah. So. Yeah, I think of insurance really as a safety net. And so you think about, if I was 50 feet in the air and I'm about to walk a tightrope line that's less than an inch in diameter, I'm not the most agile person. The probability of me needing that insurance net is significant. So one is, do I have a great safety net? But then on my side, what I can control is what can I do to widen the plank that I'm walking on up in the air, which reduces the chance of me needing that safety net, right? The wider that tightrope is up top, or that plank, if I can even build it into a 4-foot wide plank, the chances of me falling off that are pretty slim. The likelihood that I'll need that safety net is less. So that's what I look at, is the safety net piece is where I'm relying on the coverage and the policy and what that looks like. And then there's things I can do on my side to limit my risk and exposure up top, which is what I do have control of widening that plank to reduce my risk or my probability of needing that safety net. Does that make sense?
Yeah, absolutely. Yeah, I was, as you were talking, my mind was kind of going to like slacklining, right? Out here in Utah, a lot of people slackline.
Yeah.
And you're almost paying a company to show up and put that safety net under there, but you're still taking a measure to say, if I took 100-foot fall into a safety net, it still would, potentially not be fun.
Yeah.
So I don't want to have to use that safety net, but I still want a slackline, right? I enjoy it. I like being in, whatever your slackline is, business, driving fast cars, riding motorcycles, whatever your slackline is that you enjoy doing. So, hey, I'm going to put a safety harness on, right? Yeah. That if I fall, I'm still just attached to the slack line. I only fall a couple feet. I dangle. I can just climb right back up and keep going. And it's those little things of personal risk management that make you so that you don't need to tap that insurance policy is key, because you don't want to have to use your insurance, right? If you go your whole life paying insurance, you never have to use it. Yep. You will come out ahead, right, than the guy that had to use the insurance policy still. But you're wanting to engage in such a way that you say, I don't want to have to pay for a safety net bigger than I need to, right? So I know if I put my own stuff, like you said, widen the plank, put on a safety net, do the things that the controllables that I can control. I want to control them. And then I'm going to get some additional protection underneath that for the things that I can't control.
Perfect. Yeah. So let's jump into property and casualty. I think one thing that all of us need to be aware of is just like everything else in our world has increased in cost over the last several years. I anticipate that the cost of insurance is going to go up. And just to share like a recent personal experience, which was super surprising to me. I'd been at the same insurance company that had my personal home, my personal autos, and my umbrella policy bundled, and no claims. And all of a sudden I get a call from them with a picture of an aerial photo of my house showing a trampoline in my backyard. And the question is, do you have a safety net around your trampoline? And our tramp is buried in the ground, so it's literally flush with the ground. So to reduce the risk of somebody falling off of it. And so I let the insurance company know, and they're like, nope, we're going to cancel the policy because you don't have a safety net around your tramp. Almost like they were looking for a way to get out of a policy they've had in place. Because just like we all know, cost of construction has gone up, and the amount of money that that we insured, probably they're looking at it saying, we're not going to we'd lose money on this policy over time. How do we get out of these policies? And then obviously going out and moving to a different carrier is a significantly higher cost, even though we priced it out. But it's interesting to me. You hear about these insurance companies pulling out of certain states, certain areas of just like, we won't even do policies in those areas anymore. But we're seeing that change in the industry. Any thoughts on that?
Well, just like any of us as entrepreneurs have different portfolios, whether it's a portfolio of clients, it's a portfolio of rental properties, it's a portfolio of stocks, right? Insurance companies have a portfolio of policies that they've written, and each policy comes with its own risk profile, right? So as they start seeing that their portfolio becomes overweighted or underweighted in certain types of risks, they need to rebalance that out. And so in your case, I don't know which carrier you had personally, and I'm just weighing in here with some speculation. They could have looked at their portfolio and said, we have too many people that have trampolines. We got to figure out a way to get out of, we got to reduce the risk in our portfolio associated with owning trampolines. So some of our clients that have, trampolines, we might want to just go ahead and kind of figure out, we got to raise the premium on them so high that we know they're going to cancel, or we got to, ask them a question about a safety net and say, hey, we're going to cancel that. We just need less trampolines. And as silly as that sounds, that really could have been
for sure.
Right. If economy's getting tight and all of a sudden people seem to be getting hurt on trampolines more often and having, personal injury payouts, through settlements and stuff, they might just say, we want less trampolines, right?
Oh, for sure. I just imagine every one of those carriers has a room full of math nerds in the back doing the probabilities and come running out of the room of like, we got to reduce the number of policies we have to have X, right?
It sounds so silly to even think that would be like the case, but it is exactly what it is. They're called actuaries. It's a job. It is a real job. People go to college and get a degree in this, that they look at these types of things to determine what the risk profile is in particularly in the insurance world.
Yeah, so interesting.
The actuaries help understand what the risk that the insurance company is carrying, right?
So what kind of things right now should our community be thinking about in regards to their both property and casualty insurance policies? And I think we pull umbrella policies into that conversation.
Absolutely. So if you have, this is a general rule of thumb, so it's not advice, but what I'd say is my general rule of thumb is if you have more than $200,000 in assets, including, and normally we disclude this when we track net worth, but I'm going to include it in this one, $200,000 of net worth, right? So even if it's just your home that's appreciated, consider looking at getting an umbrella policy of at least $1 million. Consider that. The other thing is making sure that you have the adequate coverage. So that way, if something happens, like just looking at your situation, hey, for myself, a couple years ago, I almost rear-ended a Lamborghini here in St. George with a 9,000-pound truck, right? That would easily be more than like what the state minimums are on an
It
auto.
almost made a bad day.
That would have been a really bad day. So, and that wasn't because I was driving crazy. It's because he slammed on his brakes in a performance sports car, stop at a yellow light. So, making sure that your coverage is in check, making sure that you have an umbrella policy, which, if appropriate for you, it is a great way. Keep yourself in the right mindset. The other thing I want to say is it's a great time of year, great time of year to go revisit with whoever your insurance agent is and go revisit your policies, right? We're not in the tax season right now. Taxes are behind us. We're not in, coming into the Q4 where we're starting to do our business planning for next year as entrepreneurs. We're not trying to wrap things up. It's sometimes that little bit of slow time in the summer when you can be in find that time now to do it, right? It might be the easiest time of year to do it. So
I think real quickly in regards to those umbrella policies too, is I think particularly a lot of our listeners are entrepreneurs, professionals out hustling and grinding to make a dollar. And a lot of times that business we're doing is in an LLC or something like that.
Mm-hmm.
One of the things I think about with the umbrella policy is in the event your entity or your company gets sued, one of the things they're going to look at is any opportunity to pierce that corporate veil to go beyond just the business, which they'll try to get to you personally. Now, that is the whole purpose of the LLC, and that's a different conversation to make sure you're operating in a way to make sure they can't pierce that corporate veil. But in the event they did, that's really a critical piece for your umbrella policy to kick in too, because it's an umbrella over you and your other assets, which one of those assets is your business. So I think it's anyone in the entrepreneurial space should have an umbrella policy. And guys, an umbrella policy, if you price it out, depending on how big of a policy you get, they're really affordable in the grand scheme of things.
Yeah, I don't disagree with that at all. And and I know we had this conversation previously that sometimes it's not even about having the assets, like, I said, sometimes it's about having the lifestyle, right? So if you're somebody that isn't a high earner, right? Maybe you're a newer entrepreneur, you're still building, but you're making money. People can see that, people can tell that, people can see your success you're maybe having. And if something happens, you'll get sued anyways, just because there's the perception, right, that you may have a lot of assets. And so whatever it is that you have, they could, be trying to come after that. And the umbrella policy is just that final layer of defense that you get to play, that if there's something so catastrophic that would happen, that it would wipe you out, right? You have one last layer, one last shield to protect yourself. And that's the umbrella policy. And because it has to go, because those issues that would come up have to go through whatever, right? If it's coming through your business, right? Your E&O policy, or if you get in a car accident, it's coming through, it's got to go through all your coverage available in that policy before the umbrella policy starts to, be a pay, or there be liability by the insurance company in that regard. It like Marcus is saying, it's quite inexpensive. And so,
and you don't have to start with a massive policy either. I remember the first several years ago, the first umbrella policy I got, I think the policy was only a $500,000 policy. And then obviously as my net worth's increased to more businesses, now I have a several $1 million umbrella policy, but you can increase that over time. You don't have to start with a massive umbrella policy.
Yeah. I don't want to date you here, Marcus, at all. I haven't seen one less than $1 million. So I'm a little surprised.
Well, that was almost
that must have been before inflation.
Yes, that was 2 decades ago, but
yeah, well, but to your point, they're not expensive. So it's probably just that, today. And here's the beauty of it, right? A good agent can just get you multiple quotes, right? A good agent can just say, okay, well, hey, let's look at $500,000, let's look at $1 million, let's look at 1.5 million. And if you see that the difference between $500,000 and 1.5 million is $3 a month, guys, it's a pretty clear, right? That would be a really clear and easy decision to make. Right.
So step one for everyone is to look at your current umbrella policy. If you don't have one, I would consider one. Real quickly, one of the things I would consider on your property and casualty insurance, particularly on your properties, one of the exercises I went through earlier this year is because we had such a huge inflationary market and a lot of that inflation showed up in the form of construction materials. A lot of you don't remember that when you got your insurance policy originally on your home or your investment property, is you fill out a form talking about basically what's in your home, so that the insurance adjuster could figure out how much it would cost to replace your dwelling, right? If they rebuilt off of your foundation. And more than likely, what that valuation was a couple of years ago would not replace your structure now. And so one of the things that I went through with my insurance rep is we outlined every single one of my properties and went through the process to rethink through what would the new construction costs be at today's rates for us to replace any of those, to readjust the valuation of what the insurable amount was. So if you haven't done that in a while, I think it's a great exercise, because nothing would be more disheartening than going through a fire or something like that and being like, all right, I'm embracing the fact that we're going to have to rebuild or redo these things, and then have them build you 60% of a house and be like, we're done. That's all the money we're going to put into.
Yeah.
So just it's worth the time to just take a minute and rethink that through with your insurance rep.
Think of yourself as your insurance rep as being on your team, right? Going back to the mindset around insurance. So what I would encourage people to do is ask really good questions to your insurance agent. Don't give them a mandate, right? So when agents typically get a mandate, it sounds something like, I want the cheapest premium. Well, what you're going to get is the cheapest coverage, right? You're not going to get what you need. So what you want to do is ask good questions about, hey, if, like, because you said you had a trampoline artist. Okay, hey, let's say my kids have a friend over and breaks their leg on the trampoline. What am I covered for in that situation, right? What after this policy is in place, as we're looking at it right now, what would be my risk exposure, right? What would you guys take care of? If one of my rental properties burned down, this rental property burned down, how much would you guys pay towards rebuilding it? And what you'll find is when you have those conversations, the answers come out, and you can say at that point, when you're looking at it with the agent, I'm not okay with that answer.
Yeah.
What can we do here? And so, like in what you're describing with rebuilding homes, there's oftentimes riders that say they'll just rebuild the exact same home, whatever the cost is, right?
Yeah.
That actual replacement value. So there's ways to do that. Now, sometimes that costs a little bit more money, but if that's what you feel you need to have in place to stay in the right mindset and not be worried about things and just go out and keep building wealth through building your business, then, consider that, right?
Yep, love it. So what I think that hits the nail on the head is take some of the quick comments we're making today around that, schedule a conversation with your insurance rep. And if they act bugged that you're having this conversation with them, it's time for a new insurance rep, right? This is their job to make sure that you're amply covered and what that looks like. But it's your responsibility to look at that and decide what needs to be adjusted within that. You good if we switch our conversation to life insurance?
Sure.
Awesome. So, walk us through just quickly an overview of your mentality around life insurance. 'Cause I know some people really shy away from it, and I think there's an important play for life insurance for this community. But I think there also are some products out there that aren't great insurance products and frankly take advantage of the consumer. But there are good ways to do this.
Yes. To kind of all those things. So high level, I'm not a huge Dave Ramsey guy, but one of the things that he says that I do like is that if there's somebody out there that depends on your income, it's appropriate to get some life insurance, right? Now, how you go about that, there's a lot of different ways, but there's two primary different kinds of life insurance: term and permanent, right? And sometimes people will call permanent cash value life insurance.
Yeah, or whole life.
Or whole life. And whole life is a subset of permanent life insurance. So there's kind of a couple different things. Whole life probably being it was the original form and it's been around the longest. But term is really inexpensive. It's kind of like an auto policy, right? You pay it. If something happens, they pay the claim. And the day you cancel it, that's it, right? So it goes for a period of time or a term, a defined term. So, typically 10, 20, or 30 years. And if you were to, meet your untimely demise, while that policy is active, it pays the beneficiaries out typically a tax-free death benefit to replace what it was that you were going to be able to provide those beneficiaries, right?
Yeah.
So what that means to different people can vary wildly, right? Because for some people, they might have said like, well, I just always promised my kid that I'd pay for their college, right? So you can have a death benefit in place that if something happens to you before they go to college, it puts some money in an account somewhere for them to have their college paid for, right? That's the point. It's you've made a promise or a commitment, or there's something that you want to do, and you're saying, if I'm not around to do it, I still want that thing to happen, right? I still want my family to be taken care of, whatever. And so term is oftentimes a very inexpensive way to do it.
Let's just have our whole conversation around term before we shift to the whole life too. Because
I think that's pretty much the conversation around term in a lot of ways, right? There's not much to it. It's pretty simple.
A couple of things I would add to that, because I think you're spot on. This term policy is much more similar to like the type of policy you're getting on your home or auto. It's you pay for it, and if you need it, you get it. If you don't, you don't. But the only difference is, and I talk about this a lot in my wealth building class with people, is they're surprised that one of the first things I tell them is you should have if your net worth is not what you want to leave behind your family, and it isn't the legacy you want to leave for your people, until your net worth and your legacy is the legacy you're going to leave for kids, you need a term policy in place, because you do have an obligation to make sure some things are taken care of upon your early demise. And so term, even though it's when it's done, and you have no asset with it, it's money you paid out that you will never see unless you die before the expiration date. And that's why they put an expiration date on it, because they're counting on you not dying before that expiration date, because that's how they come up with the funds. But I do think it's important, and frankly, I think it's irresponsible for entrepreneurs not to have a term policy in place. If you really care about the people around your world and not leaving them in a bind, it is irresponsible not to have a term policy for a period of time. But then it's you taking responsibility for building your net worth in such a way that upon your demise, even if it's an early demise, your legacy and net worth, the way you've structured your assets, is in excess of what the term policy was in place. So I would keep that term policy in place until you knew your legacy or net worth was in such a way that it was providing for your family. Now, that is where whole life comes into play, is because you actually can structure a whole life policy in a way that it plays into the long-term legacy that is left behind for your family, because it can actually be an asset that is yours to be used along the way.
Yeah. Whole life is an interesting animal that we could do, and just cash value life insurance in general, right?
Yep.
I mean, we could do a 2-hour podcast on this and barely scratch the surface.
Oh yeah.
So many different ways to think about it, to understand the concept or how it might fit into play. But there's a couple important things you need to understand, is that a cash value policy is going to cost more, because what are the two things in life that are guaranteed?
Death
and taxes.
Okay.
Well, if you're insuring against one of those things, they know they have to pay the policy out at some point, right? A cash value policy is what they call a permanent policy. It will pay the death benefit at some point, because at some point you will die. We all will, right? And so because of that, they don't get to make the same bet, if you will, because they're insuring an event that will happen at some point, not an event that is, again, hopefully not going to happen. It will happen eventually. So it costs more, but it also provides an asset, because it's going to pay out at some point. It builds cash value, and you can oftentimes, now it's viewed as an asset, and you can borrow money against it. Okay. And that's where Marcus is starting to say, you're starting to say that it can play into your wealth building, because it gives you an opportunity to have a relatively safe vehicle to park funds, right? And then get access to liquidity when you need it, to leverage it into, expand operations. If you're in real estate, maybe buy properties, fund a fix and flip, XYZ thing. It gives you access to a unique tool, right? So sometimes you can borrow, well, most of the times you can borrow right from the insurance company. Actually, they'll give you a loan against your policy. And sometimes you can actually even go down to a bank and get a loan from the bank and collateralize your life insurance policy. So there's different ways to do it. There is, I mean, endless options in this stuff, right? It seems there's tons and tons of companies that write the policies, and they're all a little bit different. And they all work a little bit different, and they all have different fine print.
Yep.
But you have to understand that it's different in term because you're starting to build something that's an asset. And it's a unique asset that plays a unique part in your portfolio. It got a unique spot on your net worth statement. It's a really unique tool, but it can be something that can be very effective and also accomplish the additional benefit of, if you meet the untimely demise, it also pays an additional death benefit, and typically it should be in addition to a term policy, right?
And I think your point there of the fine print is really important, because it's not to the insurance company's benefit for you to utilize your cash value or your insurance policy to grow your own personal net worth. Because if that cash is out of their pool, what they're doing with that cash when it's in the pool is they're out investing in it, trying to beat the market, which is also, it's growing your value of your policy, but it's also growing their net worth as well. So when you take that money out to go put it to work to build your net worth, 100% of the increase on that fund is building your net worth. And so that's why that fine print is really important. So without going into all the little things you could see in the fine print, a couple things that I think are really important to point out. And Branden, I'd love for your take on some of this. Number one is I love the idea of what's called a paid up edition, which is if you're only paying the minimum premium, your cash value is growing your cash value actually is growing at a very slow pace over time.
If at all.
What's that?
If at all.
If at all, right? And that's really what the collateral, that's the value for the collateral of the policy, is not the death benefit, not what's paid out in the event of a death, but it's collateralized against the cash value. So in a paid up edition, you have the ability to overfund the account, which accelerates the cash value of your account. It also increases the death benefit over time, because the cash value of the policy is high. So now if you accelerate that over time and continue to do the max paid up edition for several years, what you start with a very small asset becomes a very big asset quickly. But now that's when you can start utilizing it to, say, making a hard money loan on a fix and flip or something like that, where now 100% of the increase when you use that fund is building your net worth, not just counting on them going out and using the funds to match the market or something like that.
Yeah. That's all a good point. So, there's a lot of different companies. They all work a lot of, they work similar, but different. We've talked earlier, and one of the things that I always like to do is when you get it's really like a quote, but they call it an illustration, right? How is this policy supposed to work every single year when you're kind of shopping for one of these, right? Always be a smart consumer, right? And ask good questions. One of the questions you should always ask is, what does this policy start to look like if I start borrowing against the cash value, right? And in an illustration, they should be able to show you, okay, if in year 12 or in year 15 or 30 or whatever, right, you start taking some money out as a loan, and you have that out as a loan for 10 years, here's what the policy looks like, and here's what the crediting should be, and here's what you could expect. And the reason why that's important is because, like Marcus is saying, when you borrow that money, it's not really advantageous for the insurance company. They'll allow you to do it, but they don't want to incentivize that. So sometimes in the way that will mechanically work on the backside, it can actually really be detrimental to the policy. And if the policy lapses, it can have some tax complications. You can lose the policy altogether. It can become a mess. So you want to understand what you can and can't do with the policy, and see it on paper a little bit, right? Ask to see it on paper instead of taking, a salesperson's word for it that everything should be fine, right? Okay, this is an asset you're going to own the rest of your life, literally, right? So let's make sure we get it done right. the first time, ask the right questions. And the question I like to ask is, show me an illustration where if money's coming out of this policy, I want to see what that looks like over an extended period of time.
Including what does it cost me to get the money out? What is the cost to get the money back in? Right.
Yeah. Those are
the fine print pieces.
There can be all kinds of different terms like that. So ask good questions.
And as a general rule of thumb, guys, this is, I'm kind of passionate. You guys know my passion around borrowing money in general for non-appreciating assets. But when I'm talking about borrowing against your whole life insurance policy or from your self-directed 401k or things like that, I'm not saying borrow the money to go buy the boat that you want for your family. This is not, oh, there's money there, let me tap into it to go increase my lifestyle. This is a wealth building asset. This is a legacy asset and should be treated as such. So when I say borrow money, it's to go make more money for the legacy you're building for your family and long term. So yeah, really, really good points on all of that. The other quick thing I'd mention on this that over time, as you continue to build your estate planning, for example, like when I started my whole life insurance policies, I didn't have my trusts in place yet. So the beneficiaries of my policy were my wife and then my kids. And then when we set up the trust, it was important for us to go back and then reset up who now are the beneficiaries of that life insurance policy. So now it goes to the trust, which inside the trust, we've created the rules of how that money is dispersed. So that's the other thing to think about, just like the recommendation I made around your property and casualty insurance, to go back and say, okay, is the policy still doing what I intended it to do when I put it in place? It's the same thing with your life insurance policy. Is, did you have another kid that's not listed as a beneficiary, that if you die today, your 3 kids are happy campers, but your 4th kid doesn't get anything, right? So it's just like this idea of like thinking through is how does this asset play into the bigger estate plan or the bigger legacy plan I've put together. Any thoughts on any of that, Branden?
Well, it's a little bit of a topic for another time, but I just, anytime estate planning comes up in any way, shape, or form, I always like to remind people, friends don't let friends do their own estate planning. So always get help from an estate planning attorney, right? One of the most devastating things.
An estate planning attorney, not just an attorney that kind of does it.
Yeah, an estate someone that specializes in it, and better yet, find one that actually will litigate estate settlements. So that way they're around. The thing that I like about that personally is if they're around to litigate problems when they come up, they know what the problems are, so they know how to write an estate plan. When they write the estate plan, they know how to write it the right way so that it doesn't create issues later on.
Yeah.
But what I've heard, one of the things I've seen to what you're talking about with the beneficiary designation, I have seen people say, well, things always change. And I got one kid that really has his head on straight. So I want to leave everything to him and tell him to divvy it up. And the problem with that is without touching the whole thing about money changes everything, right? And I'm not telling you that your kid's going to do the wrong thing, but what I will tell you is that there's likely some significant tax implications of doing it that way. And you don't want to put that burden. You don't want to put that burden on your estate and on your assets, but you also don't want to put that burden on your kid to have to deal with that, or whoever your loved one is that you're trying to leave stuff behind to. So estate planning, let's table that one for another time, Marcus. But
I think that'd be a fun conversation to have.
With life insurance in particular in the future, as the Tax Cuts and Job Acts kind of rolls off in 26 and that sort of thing happens, you'll probably see something called a irrevocable life insurance trust come back into favor a little bit more. And that's a conversation to have with your insurance agent when you're looking at permanent life insurance, and then also with your estate planning attorney. And that's a conversation you don't want to have with just either one. You want to have it with both to make sure you can pull something like that off.
Yep, love it. All right, this has been a great conversation. As we outlined at the beginning of this, is we didn't go as deep as you can go, and every one of these comments we made is a rabbit hole we could have gone down. And we basically said, let's try to stay more surface level and create the need of the conversation, and hopefully give you some bullet points to go have the conversation on a deeper level with your insurance partner. And if any of you are interested, Branden and his group are very involved in both the life insurance side and property and casualty. So Branden, if they want to reach out to you and have a further conversation around either one of those topics, what's the best way for them to reach out to you?
Cell phone, 801-600-7788. Social media, Facebook primarily seems to be the best for me. So Branden, Branden, last name Ducharme, Ducharme. Add me on my personal. If you want to follow me, you can go to Ducharme Financial on Facebook, Instagram. But
I recommend following him. He's constantly posting just short, quick snippets of things to be considering in the financial world. So I always appreciate those videos as well. But thank you again for being on. Looking forward to our next conversation. Enchilada Nation, I hope you found value in this conversation. I know all of us are so busy right now in a shifting world, a shifting economy, a shifting industry for a lot of us that is just sucking us in, and we're in the middle of the grind. Do not forget that when, even in times like this, when we are in the middle of the grind, you need to step back sometimes and put your CEO of your life hat on and say, okay, am I taking care of the bigger picture? Am I taking care of the assets that I own? And that's a lot of this conversation today. So I challenge you to take some of these nuggets from today, take some action on them. And don't forget, even though life is so busy, we got to go live life on our terms, which is the whole premise of what we're doing at the Whole Enchilada. Appreciate you guys. Can't wait to see you on the next episode.